Welcome back to Investing Talk Podcast. Today, we're tackling a question many of you might be asking about a specific company. One that really, embodies the high stakes world of turnaround investing. You send us your sources, your research, and while our mission is to distill it all down, get to the essentials, and hopefully cut through some of the noise for you. Our focus today is Enovis Corp, and the big question is now a good time to buy? Hmm. We've gotten some really fascinating material on this medical device company. Some of it even seems a bit contradictory, honestly. So we're going to unpack all of that. Before we jump in, just a quick reminder, if you find value in what we do here, please consider subscribing, liking, maybe leave a comment. It really does help us reach more learners like you. And hey, if you're feeling extra generous, you can always buy us a coffee to support the show. The link's usually somewhere nearby. Also, if there's a specific company you want us to look into for a future breakdown, just leave a comment below. We'll definitely add it to our list. Okay, let's get started. So, Enovis. For those maybe not totally familiar, what exactly is Enovis and why is it popping up on investors' radars right now, especially with this turnaround story label?
Right. So Enovis,
Hmm.
they operate squarely in the medical device and orthopedic solution space. It's a field that's, well, always innovating, always changing. They've got a pretty diversified portfolio covering prevention, recovery, and also reconstructive segments. The interest, like you said, is really because it's seen by many as a classic turnaround story.
Hmm.
That means there's this belief, or maybe just a strong hope, that the company can overcome its, frankly, significant current challenges and, pivot towards real growth and, crucially, start making money.
Okay, a turnaround play. Makes sense.
But what's immediately fascinating here, and maybe a bit confusing, is this huge disconnect in their financials. Our sources show they reported really strong trailing 12-month TTM revenue growth, about 23%.
23%. Wow, that's substantial.
It is, yeah. Hit $2.15 billion in revenue. But, and this is the kicker, they are deeply unprofitable. We're talking a TTM net loss somewhere between $809 million and $811 million.
Oh,
Yeah, and negative earnings per share somewhere between minus $14.21 and minus $14.64. This kind of gap, high growth but big losses, it often points to maybe aggressive, unprofitable grabs for market share, or maybe big one-time costs, or just a business model that hasn't quite figured out profitability yet.
right.
The sources we looked at don't exactly pinpoint the single cause for these huge losses, but those gross margins we'll talk about suggest the problem is probably on the operating side, or maybe non-operating costs, which is, key for that turnaround narrative.
That revenue profit gap is definitely,
Yeah.
yeah, it's glaring. So beyond the top line and that really concerning bottom line, what else do the fundamentals tell us? Any hidden strengths or maybe more weaknesses lurking in the numbers?
Well, the net profit margins are obviously a huge concern, minus 37.8%. That's a serious bleed. But their gross margins are actually pretty solid, 58.4%.
Yeah, that is interesting.
Yeah, it's important. It suggests their core products, the things they actually sell,
Yeah.
are profitable, which implies the issues driving that big net loss are probably somewhere else. Maybe huge operating expenses, R&D, sales and marketing, or perhaps acquisition costs, integration stuff.
Things that could potentially be fixed then.
Potentially, yes. But another big red flag, right alongside the profit issue, is the negative free cash flow, minus $63.7 million. Negative free cash flow, as you know, means they're burning cash, spending more than they're bringing in from operations.
Which isn't sustainable long term.
Exactly. It forces a company to dip into reserves or take on more debt or issue more stock, none of which are great for existing shareholders if that trend doesn't reverse pretty quickly.
Okay, so with that cash burn, the natural next question is funding. How are they managing? What's the debt situation look like? Is that adding a lot of pressure?
Well, their debt-to-equity ratio is 53.0%, which in the medtech sector is generally seen as moderate.
Moderate. Okay, so not totally drowning in debt.
No, not excessively leveraged compared to some others,
Yeah.
but they're certainly not debt-free either. And given those ongoing losses and the negative cash flow we just mentioned, servicing that debt could become a bigger worry down the line if they don't start turning a profit. If you connect that to the whole turnaround idea, it basically means their financial health, despite that good revenue number, isn't super robust. They don't have a huge cushion to absorb more debt or handle losses for too much longer.
Right. They need to fix the core profitability.
Exactly, before more debt becomes a real problem.
And what about their competitive edge? MedTech is famously tough, right? Lots of innovation, big players. Do they have a clear differentiator, a moat, as they say, to protect them while they try to turn things around?
It is tough, yeah. Their diversification, cross prevention, recovery, reconstructive areas, that's a strength. And they talk a lot about focusing on clinically differentiated products.
Meaning products that actually offer better outcomes.
Supposedly, yes. Devices that offer unique, measurable improvements for patients or make surgeries more efficient. That's definitely key for getting doctors and hospitals on board. But, like you said, the medtech sector is fiercely competitive. You've got giants, you've got nimble startups, everyone's innovating constantly. In this phase, a real moat usually comes from strong patents, or maybe technology that's really hard to copy, or maybe super deep relationships with physicians. While branding and reputation definitely matter in healthcare, the sources we reviewed don't really point to a clear, durable competitive advantage for Enovis that would shield them from competitors over the long haul. They seem strong in their niche, but it's a constant battle. Makes the turnaround even harder, doesn't it?
It does. So the fundamentals paint this complicated picture, solid gross margins, but deep losses, no obvious moat. What does this mean for future earnings then? The market must be thinking something, right? Given all the analyst attention. Feels like a bet on potential.
Well, the market definitely seems to be expecting something positive to happen. Look at the forward PE. That's based on expected future earnings, not the current negative ones, right? And it's somewhere between 7.7 and about 8.98.
Wow, that's low for medtech. Usually you see like 20, 30 plus.
Exactly. Significantly lower, which suggests one of two things. Either the market has already baked in a lot of skepticism about whether they can actually turn profitable, or it expects a really rapid and significant turnaround that would make today's price look incredibly cheap very quickly. It's basically the market saying, we think future earnings could justify this price, maybe.
Okay, so it looks cheap based on future hopes, but you always remind us, sales without profit are just, well, vanity. How useful is price to sales for a company losing money hand over fist?
That's a really critical point. Their price-to-sales ratio is around 0.7, though.
0.7. Compared to a sector median of like 5 or 6, that is remarkably cheap.
It is. It absolutely indicates the company is trading at a very low multiple compared to its revenue stream. But you're spot on. You can't pay the bills with sales revenue alone. You need actual cash flow, actual profits. For a company like Enovis that's actively losing money, price to sales mostly just tells you how much investors are willing to pay for each dollar of those sales, not how much profit they'll eventually squeeze out. It's a sign of perceived potential, not current fundamental value.
Right. Potential wrapped in problems. Okay, so if the fundamentals are complex, what's the market itself saying through trading? Let's switch to the technicals. What's the stock price been doing lately?
Okay, yeah, looking at the technical picture, Enovis is currently trading very near the bottom of its 52-week range. That range goes from about $25.93 all the way up to nearly $50, $49.83. So right now, it's sitting around $26, $36 to $27.30 per share, based on our source material. And importantly, this level, around $26, has acted as a support zone recently, meaning the price has hit this area and bounced back up before, suggests there might be some buyers stepping in around here.
Support. But has it been super volatile hitting that support, or is it kind of settling down there? Any clear trend recently?
Well, the stock has shown pretty negligible price movement very recently, almost flat, which could suggest it's consolidating, maybe stabilizing after what was obviously a significant drop from those highs near $50.
Okay, stabilization could be good.
Could be. However, its beta is quite high, 1.81.
Whoa, 1.81, so much more volatile than the overall market.
Significantly more, yeah. If the market moves 1%, Enovis could theoretically move almost twice that, up or down. For investors, that just means a much wilder ride. It really amplifies potential gains, but also potential losses. So while trading near the 52-week low with that high beta might attract some bottom-fishing investors hoping for a sharp rebound.
Catching a falling knife, maybe?
Could be. The momentum indicators right now are pretty weak. They aren't really signaling any immediate big move upwards. It feels more like a wait-and-see situation technically.
That volatility is definitely a double-edged sword. But with those analysts being so optimistic, despite these big losses, isn't there a risk they're maybe seeing something we're not, or perhaps overlooking some of these fundamental issues? What's the general feeling, the sentiment?
It's a really sharp question, and it's exactly what investors need to wrestle with when they see those big price targets. Our sources show 5 analysts rating Enovis a strong buy, and their average 12-month price target is around $55.60.
$55.60. From $26, that's over 100% upside.
It's a massive forecast, yeah. And even the lowest target among those analysts is still $46. The highest is way up at $70. So it reflects this really strong consensus optimism. They must be banking heavily on that turnaround potential we've been discussing. They must really believe management can execute, get those costs under control, boost efficiency.
Whether that belief is justified or maybe a bit too hopeful.
That's precisely the multi-million-dollar question here, isn't it?
Yeah. Any other significant news, maybe corporate actions that could have affected the price or sentiment lately? Anything besides the usual earnings stuff?
Yes, actually, there was a notable index change. Enovis was recently dropped from the Russell 1000 Value Index.
Ah, index rebalancing.
Exactly. And that kind of change can sometimes put pressure on a stock price, at least temporarily, because all the index funds that track the Russell 1000 value have to sell their shares of Enovis since it's no longer in the index. It creates selling pressure that's not necessarily related to the company's day-to-day performance. Could explain some of the recent weakness.
Right, forced selling. Okay, so for a turnaround story like this, catalysts are absolutely key, aren't they? What could actually spark a change, get the market excited again? What should people be watching?
Yeah, catalysts are crucial. And the big one here, really the main event everyone's waiting for, is the next earnings report.
Hmm?
It's scheduled for August 7th, 2025, according to our sources. This will be the market's first real chance to see if those huge losses are starting to shrink, are things moving in the right direction, is management's turnaround plan actually starting to show up in the numbers.
So that report is critical.
Absolutely critical. It's the big test. Beyond that, the sources didn't really highlight any other major near-term catalysts, like huge product launches or big regulatory news expected soon. So all eyes are really on that August earnings call.
Okay, and when you step back and look at the whole picture, what are the biggest risks you see here if someone's actually thinking about investing in Enovis now, beyond the obvious loss-making, anything else?
Well, the primary risk, and we keep coming back to it because it's so fundamental, is profitability, or rather the lack of it. Persistent losses, negative cash flow. These are just severe negatives for any business. Without a clear, believable, and executable path to making money consistently, the stock just has to be considered speculative.
High risk, yeah.
Very high risk. It reminds you of other companies where the turnaround promise lingered, but the cash just kept burning, right? That
Yeah.
can end badly for shareholders. Also, that high beta we talked about, 1.81, that means significant volatility, sharp price swings both up and down. Not for the faint of heart.
Definitely need the stomach for it.
You do. And then there are the broader sector risks. MedTech is super competitive, always changing. Plus, you've got regulatory hurdles, pricing pressures from hospitals and insurers. These can always impact growth or margins. Enovis has to navigate all that on top of fixing its own internal issues.
Okay, so summing it all up after looking through this material. Strong revenue growth, DUP losses, cheap sales, multiple, very optimistic analysts, but significant risks. What's the overall take? Is Enovis a good buy right now? Is this Phoenix about to rise, or?
Well, based on analyzing all the source material, Enovis definitely offers that compelling revenue growth story. And yes, it looks remarkably cheap on a price-to-sales basis.
Yeah.
Especially when you layer on those analysts forecasting major upside if, and it's a big if, the company can successfully execute that turnaround. The potential for a significant rebound is clearly why it's getting attention.
But
And it's a crucial but, you absolutely have to acknowledge the realities. The current lack of profit, the negative cash flow, the high volatility. This mix makes it a very high risk, potentially high reward situation. That's strong by consensus from analysts is interesting. It provides a bullish case, but you have to weigh it very carefully against those fundamental weaknesses. It really is a bet on future potential, not current reality.
feels like you're buying a lottery ticket almost.
In some ways, yeah. A lottery ticket with a potential big payout, but you're really not sure if your numbers are going to hit.
So for someone considering it, given these mixed signals, this speculative nature, what's the suggested approach? Is there a best entry point according to the analysis?
The overall rating in the source material was a 6 out of 10, which kind of reflects that uncertainty, right? Not a slam dunk, but maybe interesting for certain investors. The suggested entry price range, given it's near those 52-week lows and showing some technical support, is specifically between $25 and $28.
Okay, a tight range near the bottom.
Yes, but strictly for speculative positions. And it's really important to note, a break below $25 would be a bad sign technically. It would likely signal more downside risk and might invalidate that entry zone.
And who is this maybe suitable for? Short-term traders, long-term believers.
Well, for short-term traders, it could look attractive right now. Trying to play a bounce off these potentially oversold levels, maybe trade around that upcoming earnings report. But because of the high volatility, using stop losses is absolutely essential, non-negotiable really. For longer-term investors, it's probably only suitable for those with a genuinely high tolerance for risk, people who really strongly believe in management's ability to deliver that turnaround, to achieve consistent profitability. Until the earnings, and importantly, the cash flow turn definitively positive, this has to be viewed as a speculative bet on a future outcome.
Okay, message received. High potential, significant risk. If someone does decide to take that speculative lunge, what about an exit strategy? How do you manage the trade, both cutting losses and hopefully taking profits?
Good question. For managing risk on the downside, especially for shorter-term plays, setting a stop-loss order around $24.50 seems prudent. That's just below the recent low.
Protects against a further breakdown.
Yep.
Exactly. On the upside, for taking profits, the first potential target mentioned is around $36. That would be roughly a 38% gain from the current $26 level.
Okay. Decent first target.
Yeah. If the stock shows strong momentum and breaks through that, the next targets to look towards would be $46. That was the lowest analyst price target, remember? And then $55.60, which is that average analyst consensus target.
So clear levels to watch on both sides.
Right. Those targets reflect the kind of upside analysts are seeing if the turnaround actually works out. What a fascinating, definitely high-stakes story Enovis presents. It really is a classic case study, isn't it? Strong growth potential running right up against major profitability problems and cash burn. For you, the listener, maybe the key takeaway here is that a low stock price, even combined with really bullish analyst ratings, doesn't automatically make something a great investment, especially when the underlying financials are still, firmly in the red. This company really drives home the point that a turnaround isn't just a nice story or some hopeful projection. It needs hard proof, real execution that shows up in the numbers, better earnings, positive cash flow. So as you look at companies like Enovis, maybe ask yourself, what specific measurable signs of a true turnaround would give you confidence? Is it just waiting for that next earnings report? Or are there other milestones you'd need to see first before believing the corner has truly been turned? Something to think about. That's all the time we have for this look at Enovis Corp. We really hope this breakdown helps you make more informed decisions out there. Remember to like, subscribe, leave us a comment, tell us what you thought, or suggest another company for us to analyze next time. And hey, consider buying us that coffee if you found this useful. It helps keep the lights on. Until next time, keep learning and keep investing wisely.